Hey there, welcome back to another episode of the Park City Real Estate Podcast. Today I wanted to share some fascinating news in the world of real estate. Zillow and Fannie Mae, two major players in the housing market, have released their latest housing price forecasts. And I'll tell you, they couldn't be more different. So if you're curious about where the home prices are headed, you're in the right place. In the video, we'll dive deep into these forecasts and discuss the factors influencing. So let's grab a cup of coffee, sit back, and we'll explore the housing price predictions. So I'll start with a quick recap of Fannie Mae's forecast. They seem to be taking a more cautious stance on home prices. According to their prediction, we can expect a 1.2% decline in home prices to finish off 2023, followed by a year-over-year decline in all 4 quarters of 2024. That's a pretty sobering outlook according to Fannie Mae. If we shift gears and talk about Zillow's forecast, they are much more optimistic. You could also say bullish. When it comes to home prices, Zillow expects a 4.8% increase in home values over the next 12 months. That's quite a difference compared to Fannie Mae's forecast. So let's talk about more. Zillow identifies 37 markets where the expected price growth will surpass the average. In these markets, they're projecting an increase of 7% or even higher during that same time period. So there's some serious growth potential depending on the market that you're in. So why do these forecasts differ so drastically? Well, it's important to understand that the various factors influencing these predictions are affordable housing inventory and as real estate agents, we like to remind everyone that without an increase in affordable housing, it's hard to imagine prices are going to cool down. That also includes inventory. Fannie Mae's prediction also kind of affects that. So Zillow's bullish forecast is driven by factors such as an increased demand, when interest rates start to lower, and they are seeing some positive economic indicators. Zillow identifies those 37 markets with higher growth projections. What's also important to note is that Zillow and Fannie Mae aren't the only ones that are trying to predict home prices. CoreLogic aligns with Zillow's optimistic outlook. They're predicting a 4.6% increase over 2023 and 2024. There's quite a bit of opinions out there, but it doesn't stop. Freddie Mac, another influential institution, as we know, similar to Fannie Mae, their prediction suggests a 2.9% fall over the next 12 months, followed by an additional 1.3% decline over the subsequent 12 months. And they're not alone in this view. Other notable analysts and institutions such as Morgan Stanley, Moody's Analytics, Goldman Sachs also expect home prices to decrease in the near future. Their predictions range from a 4% decrease all the way up to an 8% decrease in 2023. These projections, combined with Fannie Mae's more cautious stance, paint a picture different compared to Zillow's optimism. So with such conflicting predictions, it'll be challenging to reach a consensus on where home prices are headed. It's important to remember that these forecasts are based on various economic indicators, market trends, and analyst assessments. So what should you make of all this information when considering buying or selling a home? Well, it's important to gather data from reputable sources, including these forecasts, and evaluate them in conjunction with your specific circumstances and local market conditions. Furthermore, keep in mind that home prices now vary more by location than they have in the past. This means that local market dynamics play a significant role in shaping the direction of home prices. So it's crucial to compile and share local market data trends with consumers and to understand them. So this way we'll have a clear understanding of where the market is heading based on local factors in our specific area. So I guess with that, I wanted to talk about what the economic indicators are for the Park City real estate market. So essentially what we have here is we're following a similar trend to last year, where just after winter, inventory started increasing. I would say about anywhere from 2 to 5% new inventory week over week. And so that has brought the inventory from about the mid 700s, that's active listings, including land, residential, townhouses, condos, etc. Brought it from about 750 or the mid 700s to what we're seeing now is we're approaching close to 1,000 coming into summer. And that's very similar to what we experienced last year. The difference is interest rates are a lot higher, so buyers are still remaining shy. And if we're looking at things in terms of absorption rates here in Park City, we're approaching 5 months of inventory. And if you are thinking about what does a normalized market look like, especially here in Park City, we're at about a 8 to 12 month inventory if it's a normalized market. So we're still below what a normal market looks like. And I think based on that, and according to these studies where Zillow is predicting an increase in home prices, we're probably more in the Zillow and CoreLogic category than we are in the Fannie Mae, Freddie Mac categories, where they think that prices are going to decrease. And we're already starting to see a lot more competition in certain price points here in Park City. And I know in Salt Lake City, it's multiplied because there's a lot more people who need to buy in the Salt Lake City, Provo, and or Utah County and Davis County markets. And so they're already seeing a lot more competition, a lot more multiple offer situations. I know there's a lot of people who are holding out for this market crash, and just based on what we're seeing in the market, there are likely not going to be any dramatic decreases in prices at the moment. We did see a slight price correction as things started to climb, interest rates, etc. However, now what we're seeing is things are starting to get more competitive as lenders and loan officers and real estate agents start to adjust these interest rate increases, and they're starting to roll out more products to help buyers get into these homes at a lower interest rate, or just based on these specialty loan products that we haven't really seen since interest rates have been relatively low prior to the COVID pandemic. So with that, hope you enjoyed this episode. And it was my first time using ChatGPT to write my script. I should probably do a little bit better at editing the script. I don't think it flowed very well. It didn't really sound like it was in my voice. That last part was me kind of riffing off of what I did study based on this news article that I read, where Fannie Mae is predicting the decrease in home prices and Zillow and CoreLogic are predicting the increase in home prices. I'm in the camp where I believe that home prices are going to start increasing, especially as interest rates start to cool off. Another important context that I forgot to notice in this or mention in this episode is that inflation came out yesterday. The CPI inflation rates came out yesterday, and we were at about 4%, which is well below what we've been previously. When interest rates started increasing, the short-term interest rates started increasing based on the Fed's meetings, it was because the inflation was close to 7, 8, and 9. And so now that we're at 4, we can start to expect the Fed to cool off on raising interest rates, which will reflect in mortgage interest rates at some point. And with that, we'll also start to see, in my opinion, a lot of buyers getting off the fence. All this, again, it's important to analyze and kind of discuss with your local real estate agents, your local markets, to decide what your local market is going to do. Again, most of this was based on a ChatGPT script, on a news article, and so hopefully it flowed well enough for you. It was easy enough to follow. I will make some edits. I will do some clips so that you can kind of start to piece together what we can expect here in the Utah market. Thanks for tuning in. We'll talk to you later.